What if I told you there's a way to get paid for just agreeing to buy stocks you already want, but at a lower price? Sounds pretty good, right? Well, today we're going to break down exactly how that works.
Okay, to get our heads around this, let's start with a simple analogy. Imagine you've got your eye on a brand new car. It's perfect. The sticker price is $40,000. But then someone comes up to you with a pretty wild offer. They say, hey, give me 1 month and I can get you that exact same car for just $34,000.
And here's the best part. They add, and listen, if for some reason I can't get you the car at that price, I'll just pay you $2,000 for your time. No catch. So you either get the car you want for a massive discount, or you walk away $2,000 richer. Seriously, would you take that deal?
Well, if you're thinking, yeah, of course I'd take that deal, you're in luck, because that exact scenario, that incredible win-win kind of setup, is something you can actually do in the stock market. Okay, let's dive into this.
So what is this magic strategy? It's called a cash-secured put. And really, it's a super popular way for investors to make a little extra income and maybe snag stocks they like for a cheaper price.
So what is it, really? Well, you're basically selling a contract. It's called a put option. And when you sell it, you're making a promise. You're promising to buy a specific stock at a specific price by a certain date. And just for making that promise, you get paid some cash right up front. They call that a premium. The cash secured part, that just means you actually have the money in your account ready to go just in case you have to buy the stock.
It really just boils down to 2 simple parts. First, you have to have the cash ready. So if you agree to buy 100 shares of a stock at, say, $50 a share, you need to have that $5,000 sitting there. And second, you sell the actual put option contract. And the moment you do that, boom, that premium payment lands right in your account.
So you might be wondering, who in the world does this? Well, it's usually for someone who's already looking at a stock thinking, I wouldn't mind owning that company. They think the stock is pretty solid, maybe it'll even go up, but they'd love to get it on sale. This strategy literally pays them to wait for that sale price to happen.
All right, enough with the theory. It makes a lot more sense when you see it with real numbers. So let's walk through an actual example using the satellite radio company, Sirius. Okay, here's the setup. At the time of this trade, Sirius stock was going for $4.89 a share. The investor decides to sell a put option, choosing a strike price of $4.50. That's the price they agree to buy at. The contract expires in about a month, and for selling it, they immediately get paid 32 cents per share.
So let's be crystal clear about the deal they just made. They've essentially made a promise that if Sirius stock drops to $4.50 or even lower sometime in the next month, they have to buy 100 shares at that price. And for taking on that risk, they were instantly paid $32. And that $32 is theirs to keep, no matter what happens next.
So once that deal is locked in, there are really only 3 ways this whole thing can play out. Let's go through each one, from the best case scenario to the, well, not so great one. The first, and honestly, the most likely outcome, is that the stock price never actually drops to $4.50. It could go way up, it could just sit there, it could even dip down to, say, $4.51. If that happens, the contract just expires. You don't have to do a thing, you don't buy the stock, and you just keep that $32 premium. Easy money.
Now this is where it gets really powerful. Think about it. You had to set aside $450 to cover that potential purchase, right? Well, making $32 on that $450 in less than a month, that's a 7.1% return. I mean, if you could do that every month, that would be an insane annualized return of over 80%. And you got it just for being willing to buy a stock you already wanted at a discount.
Okay, on to outcome number 2. The stock's price actually does fall below that $4.50 mark. Let's say it goes down to $4.40. When that happens, the person who bought the option from you is probably going to use it, and you get assigned the shares. That's just fancy talk for, okay, time to keep your promise. You now have to buy those 100 shares for $4.50 each.
But this is the crucial part. Let's compare this to just buying the stock in the first place. You originally wanted it at $4.89. Now you are forced to buy it at $4.50. But don't forget, you already got paid that 32-cent premium, so your actual effective cost per share is only $4.08. You got the stock you wanted all along, but you ended up snagging it for a 15% discount from where it was when you started. Not bad at all.
So far, this sounds pretty amazing, right? But with any investment, there's always a catch. There's always risk, and as our source material says, it's time to look at the nightmare scenario.
So what happens if the stock doesn't just dip? What if it completely falls off a cliff? Let's imagine Sirius stock just craters, all the way down to $1 a share. Well, your promise still stands. You are still obligated to buy those 100 shares at your agreed-upon price of $4.50. Sure, your effective cost is still $4.18, but with the stock trading at $1, you're now sitting on a pretty big unrealized loss, a 76% loss to be exact.
But, and this is a big but, let's put that loss into perspective. If you had just gone out and bought the stock normally at $4.89, your loss would have been 79%. Using this strategy, your loss was 76%. The nightmare is still a nightmare for sure, but the risk you took was almost exactly the same as just owning the stock. The only difference is you got paid to take on that risk.
All right, so we've seen the good, the bad, and the ugly. With all of that on the table, how do you figure out if this is actually a strategy that makes sense for you and your goals? Let's just boil it all down. On the pro side, it's pretty clear. You get paid cash right away, and you might get to buy a stock you love at a discount. The cons are just as real. Your profit is capped, you can't make more than that premium, and you are obligated to buy the stock, even if it's in a total free fall and looks like a terrible deal at that point. In the end, it really all comes down to one simple, honest question you have to ask yourself. Are you truly, genuinely willing to own this company at the price you set? You have to be happy if you just keep the cash, and you have to be happy if you end up owning the stock. So would you still want to own it, even if the price keeps dropping? Your answer to that one question tells you everything you need to know.